Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC's Ross Clark talks about upswings for equity and precious metal markets. Caldwell Security CEO Thomas Caldwell is worried overregulation will kill Canada's junior markets, causing job loss and a poor economy. We'll talk with Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome to This Week in Money, Ross.
Always a pleasure, Jim.
You were telling me off air it was a good week for equity markets and also a good week for precious metals.
Well, this has, for all that August was a devastating month at the tail end, September was a test of the low, sort of the classic formation that you would have late summer and into the fall. Here we are with October turning into one of the best months of the year. I think we're up something like 6% on the New York markets, and over on the Canadian markets, having a very good move off the bottom. Now, energies had been hit pretty badly, but they've come back very, very well. It'll be interesting to see as we move into November, December, what type of tax selling pressure there might be this year, but so far things are coming off very, very well. And, I would suggest to people that we want to be watching this rally fairly carefully. The early part of the move has been good, but you want to make sure that it just gradually gains momentum to the upside as we move through the latter months of the year.
Now, traditionally, October has been one of the scariest months on the stock market. Does it look like it's going to be scary?
Well, I think the scary was back in August, and I think that everything has been skewed about 1 month early this year. So typically October is known as the bear killer. It's the month that has by far and away the greatest number of important lows and upside reversals, and this one is true to form. The normal seasonality would have you going long at the end of the month. But in reality, the best buy was on the 2nd of October, the day that the U.S. employment numbers came out, the soft numbers, and if you recall, that then gave the investment community the feeling that the Fed would not be doing anything with interest rates in the near term. And from what I'm seeing in the reports this week, it now looks as though most of the estimates are looking for the end of the first quarter out into March of next year before a possible rise in rates. Now, we do have the Bank of Canada out next week. Might hear something from them, but, without the U.S. doing anything, Canada probably ends up with a flat rate structure next week.
What's happening with precious metals?
Pretty good week. The gold, we've been talking about resistance in that 1155, 1160 range, and then getting through there, that it probably would get up to what I consider to be important to the 50-week or the 200-day moving average in that 1185 to 1190 bracket. And we ran very quickly to there, closed off the week about 1175, and starting to see some pretty good overbought signals in the individual stocks which have run, and in the bullion itself. Also, the commitment of traders numbers, which show us the commercials and the speculative positions. There was a very big jump this week. We saw about a swing of over 30,000 contracts in terms of the speculative positions, so that if they were to have another week like that, then it would put the indicators that we watch into a sell position. So I would think if you see more strength at all next week in the metals, and the COT numbers by next Friday are into these upper levels, clearly that would be a warning sign and time to be scaling back significantly on this move that we've had in the gold and silver.
And depending on what happens in the election on Monday, that could affect the markets in Canada.
That will definitely have an effect on Tuesday morning. And, if you've got the answers to this one, you're better than me. I have a coin with three sides on it here.
I want to get me one of those.
Yeah.
Well, actually, every coin does have three sides.
That's correct.
But try getting it to land on its edge.
That is the most difficult part of this whole process. And let's just hope that market reaction next week is at least muted, if rather than being dramatic.
Ross, thanks a lot for chatting with us.
Pleasure to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. If you have any questions for Ross, you can email him at ross.clark@cibc.ca. Coming up, Thomas Caldwell on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Thomas Caldwell, CEO and chairman of Caldwell Securities in Toronto. Welcome to This Week in Money, Thomas.
Thank you.
Tom, today we're talking about the capital markets in Canada, regulatory imbalance, an industry under siege, according to a lot of people, the cost to the economy, and how our regional markets could prosper in the future. First, what are self-sustaining regulators, and are they a good or bad idea, and why?
Well, there's always good and bad to every initiative. I think what originally, and I can speak more from the province of Ontario's perspective, they felt the securities regulator, instead of being an adjunct or department of the Department of Consumer and Commercial Affairs, it should be a self-sustaining entity that is raising its fees from the registrants and companies that are covered under the Ontario Securities Act. Sounds like a good idea, but what is happening, and self-sustaining somehow became somewhat self-aggrandizing. There's been an explosion in fees, in acceleration of fees, and in regulation, and in staffing, and in salaries at the Commission. And what has happened is the regulators are actually not regulated. Now, the Canadian Securities Administrators, CSA, oversees the commissions in Canada, but they are populated generally by people who've never actually worked as professionals buying or selling securities. They're either heads of exchanges or whatever. So they're more on the administrative side. So there's not a check and balance on regulatory burden and what its impact on policies, economic policies are.
Now, what kind of money are we talking about with these regulators? I think they all make salaries around $200,000 or better.
Oh, yes. Well, I think the chief regulator in Ontario makes $700,000, which makes him probably among the highest paid civil servants in the country. I think. I don't know. I'm only giving you a hearsay, so I wouldn't necessarily take that to the bank. But they are well compensated. Let me put it that way.
And how many of them are there that are making $200,000 plus salaries?
I haven't done a study of the commission. I couldn't give you a breakdown.
But a lot of them.
Of who's making what. It's they're well a lot of them are lawyers, so you have a lot of lawyers who either sharpening their teeth in the securities world or careerists at the commission. So you're talking an explosion in staffing into the many hundreds of people versus double digits 15, 20 years ago.
Now, what do the regulators spend all the money on that they collect? Is it mostly salaries?
Well, again, I haven't seen their budgets, the OSC budget. I mean, clearly they're not buying buildings, et cetera. So there's equipment, there's overhead, there's computers, there's screening mechanisms, there's software. There's the usual expenses of any organization, and obviously salaries as well. So clearly it's covering their overheads at every level.
Is this typical of a lot of people with a little fiefdom? The more people they have working for them, the more successful they feel they are.
Well, I think that's a government phenomenon in many sectors, many of the economy and of government. So I think it's not something that's unique, say, to securities commissions.
But it does seem to happen a lot. Instead of trying to do the most with the fewest, they try to get the most and then decide what those people are going to do.
Well, it's a little bit self-sustaining. I mean, there's several traditions that have grown up. For example, regulators fund theoretically consumer protection organizations, which are really a lobby group on behalf of regulators, continually pointing out areas where we need more and more regulation, more and more disclosure, and this is paid for again by fees from the registrants, which in my mind is a misappropriation of funds. So what is happening is it's like the fire department hiring someone to run up and down the streets yelling fire so you can get bigger and newer fire engines. So there's an element of that. The challenge is that it states that the policy parameter is that more disclosure, for example, is better. Well, it's not, because we're at overload. For example, people don't read prospectuses anymore. It's too confusing, too detailed, too voluminous, if you will. And with the new accounting rules, the International Financial Reporting Standards, IFRS, financial statements are now becoming the same. So what you're having is professionals communicating with professionals, lawyers with lawyers, and accountants with accountants, but really not with any consideration as to the meaningfulness to the investors or shareholders in these companies. So I think the disclosure side has become so great that you're running into investor fatigue. Well, I know you are, as a matter of fact. People just don't read stuff anymore.
Well, I was going to say, too, if it's in legalese, even lawyers find legalese boring.
Well, it's a case of too much disclosure is no disclosure at all, because people just shut down. And that's where we are. We've gone well past the tipping point in that regard. And it's like anything. Listen, we need regulations. I mean, no one's disputing that at all. My thesis is that it has to be more efficient, because much of the regulation that we're now seeing relates to policy, procedures, really not anything in the area of investor protection. And I think what we should be aiming for is an efficiency both from the regulator point of view and the regulated point of view. It's, for example, if you have regulations that are simple, clear, and working to a theme, they're a lot easier to comply with, to work toward. But what is happening now is a system that's Kafka-esque, if you will. You can never come up to the mark. The rules are continually changing. Securities regulators can't keep up with the volume, or securities lawyers, of the volume of new regulations that are coming out of regulators. And because every lawyer up there comes up with a new idea, we should have this, we should monitor this and that sort of thing. So it really is self-defeating, and it actually takes time away from the real job of looking at investments, researching them, etc. Give an example. I think brokers are now expected to update the new account forms once a year. Well, typically that's a meeting with the client. The average broker, reasonable, would have 500 accounts. That means they won't have any time to do anything else. They'll just be going from meeting to meeting to meeting through the year. They just keep up with the paperwork of the stuff. So that's just a very simple kind of example. But firms now, I mean, for example, the cost of regulation in the independent firm world is about, we used to say about 50% of all your administrative costs. It's now higher than that, 60 to 70% in there, which is an unsustainable model, which means you're losing independent mid-sized firms, and we've gone down from over 200 to about 120 at the present, and we generally lose about 20 firms a year. And that almost looks like design, if you will.
I was just going to ask that. Are they being squeezed out by design, or are they just collateral damage due to all these regulations?
Well, I'm inclined to say both. Clearly, the larger firms, our bank-controlled firms in the industry, they do a good job at the thing they do, but they have the systems to accommodate ever-increasing regulatory burden. They have the bodies, et cetera, to do it. Also, it has the desired effect of removing competition from the industry as well. So you kind of wonder, the problem is that these mid-sized firms, not ours in particular, are the companies that finance new enterprises, and those are where we create jobs. Those are where we create economic growth. And I've told the Minister of Finance, you can have your fiscal policy on full expansion, you can have your monetary policy on full expansion, but if you have your regulatory policies on lockdown, then what you'll have is basically a branch plant mentality and a jobless economic recovery, and that's really where we're at.
Right, so you're saying the policymakers don't know that these people have slapped so many regulations on that you actually can't do anything, whether the policy says you can or not.
Well, basically the policy for all regulators is to balance capital market efficiency with investor protection. that balance does not exist. I don't think the politicians or governments are cognizant of that, but even if they were, I don't think they'd make any change, because the mantra through their lobby groups, regulatory lobby groups, or whether through the media is, we need more regulations, Mrs. Smith is getting mauled, etc. Mrs. Smith has gone a long time ago. She's already been impressed into bank wholesale products. I mean, nobody even wants to cover a small account. It's too dangerous and too costly now. It's this continuing pressure to do it. So no politician who wasn't other than suicidal would say, we got to ease up in securities regulation, because the first scandal that occurs, which aren't very many given the horrendous volumes of trades that go on every day, would be held responsible for it, and some political opponent would use it as a battering ram to get at some other political person as well. So no politician is going to do it, even if they understood the impact of what's happening. We'll probably have to get to an extremist position where finally people say, we're not replacing head offices in Canada. Look at the companies in Canada: Falconbridge, Alcan, Inco, Noranda, Stelco, Algoma Steel, Dofasco. They're gone. They're all gone, and we haven't been replacing them. And new companies, say, coming out of, say, in Ontario, for example, Kitchener, which is a high-tech hotbed, it's almost impossible for someone who started a company, needs to raise $10 or $15 million to raise it with the capital market structures that we have in Canada. So they're faced with the risks and the costs of going public, or selling the company for $100 million and going sailing with their girlfriend. There's a real tough decision.
Is there anything that can be done to improve this, or is IROC going to be stuck there and you're stuck with it forever?
Well, it isn't just IROC or the Ontario Securities Commission or the CSA. I always give everybody the benefit of the doubt that everybody's trying to do the right thing, as they have the light to see that right thing. It's their perspective, and it's very easy to see yourself on a crusade protecting, the small investor. I mean, a good example, you cannot recommend a speculative security to anybody over 65 years of age. Well, I'm over 65. I like to think I'm a little bit smarter than I used to be. And, you've got some massive and significant and successful investors out there in British Columbia, some of whom are over 65. And, I don't know what would happen if somebody, said to Mr. Patterson, you're too old to own common shares kind of thing. But that's what happened in this nanny state. This struck someone as a good idea. But often people over 65, and I'm not talking about pensioners who don't have any money enough to understand all that nonsense. I'm talking about people that, like me, I don't have to deal with a mortgage anymore. I don't have to pay for my kids' schools anymore. So I don't have the same overheads, and I've managed to accumulate a few assets. And if I want to take a higher risk investment, I should be allowed to do it. The government shouldn't stand in the way of that. I don't know where that presumption even comes from.
All you have to disclose really is this is a high-risk investment. Do you understand that?
Doesn't matter. Can't do it. Or their son-in-law just gets out of law school and goes back 5 or 10 years and says, Granny lost money on this, or my granddad lost money on this, and we want that money back, because clearly it wasn't acceptable. So even if a broker put high-risk investments, the regulator can override that and say that's inappropriate for the investor, you can't do it. And that's a relationship between the investor and his or her advisor, and they can circumvent that and override it.
We're speaking with Thomas Caldwell, CEO and Chairman of Caldwell Securities in Toronto. Tom, who is regulating the regulators? Who watches them to make sure they're not overstepping what they're supposed to be doing?
Well, the answer is, in reality, it's no one. Theoretically, it's the Canadian Securities Administrators, the CSA, none of whom have any experience in buying, selling securities on a professional basis. They're talking about administration, etc. So there's a kind of a tentative arrangements between those two bodies that nobody sort of gets in each other's way. Everybody rubber stamps and goes along with it. I'll give you a good example. We come up with a client relationship model, which adds tremendous costs and overhead, and the parts of it are good, don't get me wrong, for brokers to put in place. I was speaking to a group of regulators a while back, many of whom had worked on this client relationship model, and I asked for a show of hands of those people who had worked on it who had actually bought or sold securities professionally in their investment career, for a show of hands. No hands. No experience in the reality of the business. All these nice ideas, etc., but there doesn't seem to be the communication that should exist. And the problem is, if you say anything, there's an arrogance too in the regulatory world that if someone in the industry says something, well, they're a vested interest, ergo they can't be listened to because they're clearly either, immoral, illegal, or kind of sleazy kind of thing. There's this arrogance that your opinion would be discounted. And listen, I've bought and sold securities for over 50 years. I mean, this is what I do for a living. I have a modicum of experience, and many other people do. And I got to tell you, most of the people I've met in my career, the vast, vast majority, work very hard to do a good job for their clients because you get very close to your clients. I'm godfather of my clients, kids, etc. These are friends. These are relationships. You work hard, and the fellows that I've known in the securities industry who've taken their own lives over the year, and there's been 9 of them that I've known directly, and there's a lot more than that. It's when they felt they let somebody down. So there's a very high conscientiousness. And yeah, do you have sociopaths in this business? Yeah, you have them in every business. But the numbers are irrelevant in terms of the body of business that's conducted on an ethical, best intentions, best efforts basis for the clients. It's irrelevant, really. And the old penny stock brokers, they're long gone, for Pete's sake.
Don't the regulators know that by putting in harsh rules, they're discouraging people from investing in Canada's future?
Well, I don't think they understand the important connection between economic growth, job creation, and the investment industry that raises money for companies to do just that. By hitting this very integral component of economic growth, what they are doing, in fact, is stifling job creation and economic growth. But I don't think any of them have either taken Economics 101 or really understand or see what they're doing. They get a mind lock of, well, we've got to get more information out, we've got to tell people more, and we've got to constrain what these brokers are going to be doing. I've never seen a profession, and yes, profession is the right word, so demonized in my whole career. This is an industry, as you said earlier, under siege. If I were to come at the business now seeing what I would never go into this business again, ever. I mean, it's almost as if you cannot function economically because you have governments and your regulator determined to destroy you. It's as if we want to have just basically everybody dealing with a wholesale model at their large bank or through their teller, etc. And then we're going now to robo advisors, etc. And where's the advice? Where's the listening to the client? Where's the understanding of stuff and the professionalism? And it's in none of those environments.
If you were the head of the securities regulators, what would you do to make the Canadian capital markets the best in the world?
Well, you're supposed to do a benefit analysis to every regulation, and that's a lip service item now. It's something people say they do, but it isn't done. It's oh yeah, that looks good. That's okay. That's not going to cost much money. I've been on the board of the IDA. That's the predecessor to IROC for several terms over the years. And in my last stint as a director, I asked staff to come to meetings with showing me how you can take 2 regulations or regulations that are overlapped and make it into one. To make it simpler to understand, hire somebody from Sesame Street to write it so that people can understand it. Get rid of regulations that are not fundamental to making an informed, intelligent investment decision. That doesn't mean every bit of it. You don't take them over the verbal landscape. What do you know that's important? That's my job as an investor. I have to discern what's important against a whole bunch of data in an over-newsed environment. And we have exactly the same regulation. So I would ask for efficiency, I would ask for better focus, and review what we have and see where we go from there and start cutting. I would also ask the people involved, the auditors of firms, etc., to treat the companies that they're regulating with the respect they deserve, that these are people trying to do the right thing, and be respectful of the time constraints you're putting on them. I mean, we had one regulatory audit in here was supposed to be, I think it was 2 weeks or 3 weeks. The guy was 2 months, and every little thing in the firm went over this and that and the other thing, and that's not respectful of your registrant's economic reality as well. You're taking people out of the line, and So, I think it's a case of understanding what you're doing for a business, simplifying it, making it efficient, have respect for the people you're dealing with, respect their time. Many years ago, I was asked to come if I'd like to come up and go through the regulations with their lawyers on a line-by-line basis. I said, that's a wonderful idea. I assume your lawyers are being paid. You'll probably have 5 or 10 doing that. I said, no, what would be my compensation? Oh, you're doing it for the good of the industry. And I said, well, I do have a day job, and I am responsible for my clients. So, but that's exactly what I mean. And that was just a run your engines dry kind of tactic, if you will. So I would strive for efficiency, relevance, what's important, chopping them down to where I've got something I can work with. It's not only easier to police, but it's easier to comply with.
Has this discouraged people from getting into investment in the first place?
Absolutely. You can't be hammering the critical component of the industry without hammering the credibility of the industry in and itself. That is, I don't know, why I should buy. And frankly, the complexity we have in markets has really arisen from the regulations. I mean, high-frequency trading, that came out of a multiplicity of exchanges created through regulation NMS in the United States, 64 exchanges instead of 2 or 3 major ones. The flash crash was purely regulatory inspired, where they had rules on 2 exchanges and none of the rest. So I think it has seriously undercut people's appetite, because you're seeing, in the newspapers, and they're complicit in this, continually hammering, what's not important, and and this broker, and they're doing that, and they're charging you too much, and they're not offering value. Whereas if you just buy our paper and read my column, you're going to get really rich like me. It doesn't work that way. So I think, yes, the sum total of this has dissuaded people from looking at common share investments, investing in companies, investing in the country, and instead, maybe I'll buy a condo with my friends or something like that. It's shifted the focus of investing dramatically. Or you just go to the bank and buy your PAP bank mutual fund. And, they've got all kinds of exotica and that stuff as well. But in terms of sitting down, discussing your investment needs, your serious investment needs. And whenever there's a scandal with investments, it's usually people who aren't registered. I feel like saying to the regulators, the crooks don't bother reading the rule book. They don't care. And there's all kinds of guys who set up a sign, and they're not registered with IROC or any of the commissions. And whenever they do something bad, it slams into the rest of us, and we get even more regulations. I mean, it's a joke. Anything goes wrong in the U.S., we get more regulations in Canada. It's really a noose continually tightening, and I don't think any firm in our industry doesn't wonder how long they can continue in business in this current environment with the trend of this environment. And I think as Carly Simon said in the song, you don't know what you got till it's gone.
I think it was Joni Mitchell.
Well, whatever. I'm not exact on that.
Well, Joni's a Canadian, and that's what she said.
Then.
Big yellow taxi. The junior resource markets in Canada have been in a horrible long bear market. Brokers with small clients are closing their accounts or charging fees if they do not trade within a period of time. When the bull market returns to the resource sector, along with investors, will the brokerages regret the way they treated clients during this horrible bear market?
Well, again, you're using the brokerage. Don't use it as a homogeneous term, because our firm does not do that, and so it really depends on the firm. Some firms are desperate. Some firms actually want to get small clients off their sheets. It really depends on the economic or the business model that each enterprise has. I think clients are you got to put the client first. And we have lots of clients on our sheet that we don't earn any money. We just hold their securities, and they're commission based, which of course they've tried to get us to get away from and charge fee based. Fee based is not as good for a client as commission based. But commission based, everybody wants to run to the discount broker, and then they get nickel and dimed on other fees on top of that. So you almost can't have it both ways. But I do think that, the resource area has been just slammed tremendously with low prices, whether it be energy, whether it be base metals, gold. But there does seem to be a comeback coming in there. And, listen, if they have not treated their clients well in the bad markets, then, clients remember that. And people know if they're appreciated and they know if they're valued. And, I always keep telling our brokers, your client's first and you're third. That's just in case you're too close, it's second. And that goes right through the organization, that you take care of your clients and you'll have a good business. It's just as simple as that. And you do the extra And you don't chintzy them, you don't nickel and dime them to death, and that's just good business practice. But if other firms want to do that, that's fine. I mean, that's their business. We'll end up getting their clients too eventually.
We're speaking with Thomas Caldwell, CEO and chairman of Caldwell Securities in Toronto. We've been talking about how overregulation is killing the investment in small business in Canada. Is this something that should be brought up during the election, or should have been brought up during the election? Or is this so complicated that, for a 10-second or 15-second soundbite by a politician, we really wouldn't get much from it?
I think the latter point is probably correct. It's complex for people, and they are so mentally conditioned via the media that, brokers are just, it's a step down from a bookie, for Pete's sake. So you're not going to get any you're not going to win votes by saying we got to simplify and ease, regulations. I mean, it sounds good to say we got to do job creation and have some, half-baked government program. If you hire somebody north of the Arctic Circle, who's over 78 years of age, you get a government grant. I mean, they always gerrymander these grants. Listen, I'm an entrepreneur. I started a firm over 35 years ago. I've never been able to access one government grant on anything, whether it be interns, students, or anything. It's just too complex. If you're running a business, you're running a business. So if you want to build an economy, you have to work on the basis of simplicity, ease of entry, economics of maintenance of an organization, of a company, and capital market access is horribly important, terribly important. And as you constrain that and you cut off the people that can provide those funds, you will have a very significant cost, but it's complex. I own an investment in a junior exchange called the Canadian Securities Exchange. Great business. And I was at one of their presentations. They had about, 10 different companies talking about, they were doing. And they were good people. They were highly committed to these businesses. They were trying to create these dreams, good execution, good plans. And through the whole presentation, I felt so badly because I knew most of them would have a great deal of difficulty accessing the capital they need to make these dreams, these enterprises, and these jobs come into being. The systems are already broken in that regard. And there's the cost. You're not even going to see that cost. You're never going to see what could have been. But that's where we're at now in this process. And I don't think politicians understand it. I don't think they want to understand it. There's no votes in talking about securities regulations. Ergo, you're left to discuss PAP or extreme issues, a la Mr. Trump sort of thing.
Well, it seems to me every time the government says we'll help create jobs, their solution is, well, we'll build a new bridge, or we'll pave another highway, or build a library or a new city hall. But that doesn't help Canada sustain jobs or grow jobs in the future, does it?
No, they really look good projects, and they cut ribbons in front of it, and it really looks as if you're doing something. And I know one of our parties was talking about building infrastructure and everything else. So that's good. That's well and good. But what is more important is permanent jobs. Enterprises Canada is an entrepreneurial hotbed. It's incredible. I've been the length and breadth of this company, talking to people, guys and gals who have really good ideas, and we have far more of an entrepreneurial spirit than one would think. But we're letting these people down on the ability to create these companies and make them work. So we're losing the United States. Many are getting sold out in the early stages. And we're not replacing all these head offices we've lost. And that will have a tremendous economic impact on future generations. And I think what is going to happen, you'll just see a continual leakage toward America for enterprises because the capital is there, readily accessible in big pools. But you're also seeing in Canada and in the United States a greater reliance on what's called private equity, because it's far easier to raise money in the private side and not go public without all the grief, aggravation, risk, etc., and costs of being a public company in Canada. And that's wrong, because that's how we built this country. That's how we built a great country, was through access to public capital for ideas, entrepreneurs kind of thing. And not everything's going to be successful. Brand new enterprises, the majority aren't going to make new brand enterprises. But mid and up, that's where we have to nurture them and bring them along. And we're not doing that.
Could you see the eventual death of the Canadian junior and mid markets?
Yes, yeah. In fact, I don't think it's eventual. I think in terms of the junior, it's virtually there now. It's just oddball deals being done. I mean, years ago, if I want to do a junior company of some kind, I could walk up Bay Street or, Howe out there or anywhere, and in Vancouver or wherever, and I would have 10 or 20 brokers I could talk to see if I could get them to finance my deal. Now you're probably looking at just one or two in the whole country. So there's very few able to do it. Maybe 5, but something like that across Canada. So it's already happened. Mid-sized companies, sometimes they can raise the money, but they'll generally be raising it in the private equity market, which is higher cost money.
Right. What about crowdfunding? Is that a real solution, or is the amount of money so minuscule you can't really get going?
Well, I think it's one of these things that sounds and quacks like a duck, but I don't think that's a solution. And it's sort of a schizophrenic approach. It's like we regulate the real markets right out of existence, but you can raise some money just by putting your name on an internet site and just have money come in with no disclosure at all. It is schizophrenic, but the amount of money, and they're trying to get on top of this to constrain it, is such that it's not going to be a factor in job creation or anything in a significant way. But again, government's trying to get ahead of technology, but they really can't. There'll be other things that'll be funding, but the private equity sector seems to be the one that's trying to fill the gap. But we don't have enough big private equity pools in Canada. The United States is different. You got monster amounts of money doing that. So it makes our whole economic growth engine vulnerable to U.S. takeovers.
I was going to say this virtually forces Canada to be a branch plant of the U.S. because you can't do it internally.
Absolutely.
Are people now going outside of Canada to look for investment inside the country, going to China, going to Japan, going to the U.S., asking or pleading with them, if we can't raise money on the Canadian markets, can we use yours?
Yes, it's U.S. primarily, not to China yet. China's investments are slightly different coming into Canada. They're bigger stuff, government controlled. At the individual level, typically it's like any new immigrant to a country. You go to real estate first. You want to own your house. You want to own, or in Canada you might own 4 or 5 condos. The Chinese folks seems to be the real assets. And it's partly because of a lack of history, understanding, or tradition in public capital markets. So typically for the Canadian company, some guy out of Kitchener, Ontario, has come up with a new high-tech gizmo. He's probably going to learn very soon that he might start with love capital. That's friends and family putting up some money. Okay, the product's successful. Its next stage is, where do I get some money? Maybe in the old days you could say, well, maybe I could raise some money in the public markets. Well, the costs are so high. Prospectus $100,000. I mean, it's too. So that would be quickly excluded as a possibility. The next step will go to private equity, and which you might raise some in Canada. The bulk of it is in the States. It's just flowing into anything high-tech in Canada. All of our high-tech stuff is being drained off because of our capital market structure that we created. It's just being drained out of Kitchener. And nobody's even paying attention to that, and that's been going on for years now. So if you did go private equity in Canada, then that private equity holder, they're going to look for an out at some point, 2 to 3 years out, and their out will probably be to a U.S. company. So that is just a delaying mechanism for the final exercise of U.S. company coming into Canada and taking over that enterprise. That may or may not have been another BlackBerry, because like it or not, BlackBerry is and was and still can be a success. Although you look at our Canadian high-tech companies, either they blow up or they're gone. And the number of high-tech people and skills that we have in this country, it's quite pathetic, the number of real high-tech companies we have out there in Canada. Just a handful.
We certainly have the education to get people going, but you're right.
Absolutely.
Everybody I know who went to the British Columbia Institute of Technology, became computer experts, they've all moved to the U.S. because they said, I can't expand my skill set here or make enough money to make it worth my while.
Well, they're quite correct, but that too is that the companies do not exist or remain here that would have the resources to become world beaters. And everybody's, it's a lack of, we're too conservative. No, it's not that at all. It's the structures that we've created. We have the people, we have the education, we have a far better worldview and understanding of the world than, say, our U.S. cousins have. And we're very well regarded in the world. I've spent a lot of time roaming the world, a lot of time. Canadians, they're held in very, very high regard, but we're just not there. And the reason we're not there is we don't have the companies to get us there to get into these markets, and that means that's a reflection of we don't have the capital to build those enterprises.
In other words, this over-regulation isn't just killing investment, it's causing a brain drain.
Absolutely. But,
is there any way, I was going to say, is there any way that this can be corrected, or because the monster is so big, it's a case of you just throwing spears against armor plate?
Well, I have to tell you, personally, I feel like a cry in the wilderness. And also, anytime you speak out against regulation, you instantly make yourself a target. Because, they don't like people speaking up against the system. And, it's like that old joke, paranoids can have some real enemies, and we see that as well. So, there's no upside. It's almost like a game, maybe I'm just getting a little too despairing. I've been at it so long that I don't know that one can win. I don't know that one can change the direction of this juggernaut. I don't know what it would take. I mean, guys like me and other folks you've chatted with will all speak up on it, but we're like cries in the wilderness. And as you say, it's like spears bouncing off of armor plate. I don't think you can change it because the regulatory establishment is so powerfully entrenched, and media and lobby groups supported, and sometimes very large organizations supported as well. I know there's some folks out in British Columbia that feel that, there's the larger firms in our industry that are behind this. I mean, I'm not quite that paranoid, but there can be a factor of that in there. But it's I don't know what's going to change it, and I wish I could say, here's what we're going to do, and here's how it's going to change, and this is going to happen. All I can do is just be a commentator on what is happening, what is coming, and what exists right now. And I have no axe to grind in this. I mean, we don't do any financings of junior companies, so it isn't anything that we even do. We're talking with the macro of what it's doing to the economy. I'm trying to speak up for, what I believe is the greatest country on the face of the earth, and saying, hey, our part of our model is broken, and we can make it better, but no one sees it as something that needs improving until we look around and all of a sudden. And remember, by the way, our big financial institution, there's a whole thing coming in technology called blockchain. That's going to result in thousands of jobs leaving the financial sector in the major banks because it eliminates the next wave of technology. But that's a topic, this blockchain thing, which is the software behind Bitcoin, but it's not Bitcoin. This is going to be a tremendous efficiency booster for banks, which is a euphemism for less people. So where's the job creation going to come from? And unless it comes from new enterprises and innovation, we're not going to have them. We're going to have high unemployment. We'll be a branch plant mentality, and that's it. And that's where we're going now. In Ontario, which was, of course, a manufacturing hub, we're experiencing it now, despite what's happening in our dollar.
Tom, can you tell us more about Caldwell Securities?
Trades on the Toronto Stock Exchange, URB.A, and performance there, just as, for example, it's been just under 16% annually compounded for the last 13 years, so which I think blows apart any other index. So I think overall we've done well for our clients. I mean, that's one of the ones I'm responsible for. And as I say, it trades as a public company on Toronto. The clients of our firm have been, as I say, I have many multi-generational clients since I've been in the industry, so we've managed to keep our clients. We have a very experienced staff, really good, smart guys and gals. Many of them are here. My secretary is a new girl. Our assistant, she's only been with me 17 years. So, we don't have a high turnover. People seem to enjoy it. We have branches in Ontario. We did have a branch out in British Columbia, but we closed it up about 15 years ago. So we cover most of our clients from Toronto.
Well, thank goodness for the internet.
Yeah, it does. Well, it's a great help in many ways. It drives costs down. I mean, technology is deflationary. It's also antisocial, but it does bring costs down. Is there a website people can go to? Yeah, just go to caldwellsecurities.com.
Thanks a lot for chatting with us.
Thank you so much. I really appreciate it, and all the best, Jim.
My guest has been Thomas Caldwell, CEO and President of Caldwell Securities in Toronto. That wraps up our show for this week. Thanks to our guests, Ross Clark and Thomas Caldwell, and thank you for listening. Comments or questions for the show can be emailed to info@howestreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.